If you're studying financials, reporting, or preparing for exams like ACCA, one important standard you need to understand is IAS 10, events after the reporting period, because it explains how companies should treat events that happen after the reporting date but before the financial statements are authorized for issue. And in this video, we'll break it down in a simple and easy to remember way so you can apply it confidently in exams and in real-world scenarios. First, let's define the key idea. Events after the reporting period are events both favorable and unfavorable that occur between the end of the reporting period and the date when the financial statements are approved. And the standard divides these events into two main types: adjusting events and non-adjusting events. Adjusting events are those that provide additional evidence about conditions that already existed at the reporting date, which means the financial statement should be adjusted to reflect these new pieces of information. For example, if a customer who owed money at the year-end goes bankrupt shortly after, this confirms the receivable was already impaired at the reporting date, so the company should adjust its accounts and recognize a loss. On the other hand, non-adjusting events are events that relate to conditions that arose after the reporting period, meaning they do not affect the figures already recorded, but they may still need to be disclosed if they are material. For example, if a company's factory is destroyed by a fire after the reporting date, this event did not exist at year-end, so no adjustment is made, but it is important enough that users of financial statements should be informed through disclosure. Another important concept in IAS 10 is dividends. If dividends are declared after the reporting period, they are not recognized as a liability at the reporting date because no obligation existed at that time. Instead, they are disclosed in the notes to the financial statements. The standard highlights the going concern assumption, which is critical. If events after the reporting period indicate that business is no longer a going concern, then the financial statement must be prepared on a different basis, even if those events occurred after the reporting date. So to summarize everything clearly, IAS 10 requires you to identify events after the reporting period and classify them into adjusting events, which require changes to the financial statements, and non-adjusting events, which require disclosure but no adjustment, while also paying close attention to special cases like dividends and going concern. And once you understand this classification and logic, you'll be able to handle most questions related to IAS 10 with confidence. If you found this explanation helpful, don't forget to like the video and subscribe for more simple breakdowns of IFRS standards, and let me know in the comments which topic you want to learn next.